Have you ever wondered what would happen to your family if you woke up and your bank account simply said unavailable, not hacked, not stolen, just frozen because your bank collapsed faster than you can finish your morning coffee? I've spent years researching financial systems, bank failures, and what separates people who survive economic chaos from those who get crushed by it. In 2023, Silicon Valley Bank went from perfectly fine to completely dead in 48 hours, trapping billions in customer deposits. Let me repeat that because it sounds almost impossible. 48 hours, and most Americans had zero cash on hand to survive it. Today, I'm going to tell you the exact amount of money you need in physical cash to survive a banking collapse. The number might blow your mind. If this changes how you think about protecting your money, hit subscribe and give this video a thumbs up. Here's something that's going to shock you. Since the year 2000, more than 560 banks have failed in the United States alone. Let me repeat that because it sounds like something from a history book about the Great Depression. Over 500 American banks have gone under in just the last 2 decades. And here's what makes it even more unsettling. The pace is getting faster, not slower. In 2023, we watched 3 of the largest bank failures in American history happen within a span of just 2 months. Silicon Valley Bank collapsed on March 10th with $209 billion in assets. 2 days later, Signature Bank went down with $110 billion. That's nearly $550 billion in bank assets that evaporated faster than free pizza at a college dorm. These weren't small community banks in towns you've never heard of. These were major financial institutions with fancy offices and reassuring commercials telling customers their money was safe. But wait, it gets even more incredible. When Silicon Valley Bank started showing signs of trouble, the actual collapse happened in roughly 48 hours. On Wednesday, everything seemed fine. By Friday morning, federal regulators had seized the bank and customers couldn't access their accounts. Think about that timeline for a second. You could go to bed on Wednesday night feeling financially secure and wake up Friday morning unable to buy groceries. And this isn't just an American problem. In 2013, Cyprus shocked the world when the government actually took money directly from people's bank accounts. Depositors with more than 100,000 euros lost nearly half their savings overnight in what officials politely called a haircut. Imagine logging into your account and discovering that the government had simply helped themselves to 47% of your money. No vote, no warning, just gone. Greece went through something similar in 2015 when capital controls limited ATM withdrawals to just 60 euros per day. Picture trying to run your life on 60 euros a day because some bankers made bad decisions. Now you might be thinking that these things only happen in other countries or to other people. That's exactly what the customers at Silicon Valley Bank thought too. According to FDIC data, about 94% of deposits at Silicon Valley Bank exceeded the federally insured limit of $250,000. That means almost everyone with money there had funds that weren't fully protected. They assumed their bank was rock solid. They assumed the system would protect them. They assumed wrong. The speed of modern bank runs is something financial experts are still trying to wrap their heads around. In the old days, a bank run meant people physically lining up outside branches to withdraw cash. That took time. Word had to spread. People had to drive to the bank. But in 2023, depositors withdrew $42 billion from Silicon Valley Bank in a single day using nothing but their phones. That's the fastest bank run in history. And it happened because digital banking means digital panic spreads at the speed of a tweet. But statistics are one thing. They're just numbers that don't feel real until they happen to you or someone you know. So, let me tell you about someone who lived through this nightmare firsthand. Meet Sarah Chen. She was a 3-4-year-old marketing executive at a tech startup in San Jose, and she had done everything right. She'd saved diligently, kept her emergency fund at a reputable bank, and felt completely financially secure. On March 9, 2023, she had $87,000 sitting in her Silicon Valley Bank account. By March 10th, she couldn't access a single dollar of it. When Sarah woke up that Friday morning, she checked her phone like she always did. The banking app wouldn't load. She figured it was a glitch and went to make coffee. An hour later, she tried again. Still nothing. That's when she started seeing the news alerts. Her bank was gone. Not struggling, not reorganizing, not being acquired. Gone. Federal regulators had stepped in overnight and shut the whole thing down. You can probably imagine how that felt. Sarah described it as a kind of surreal panic, like watching your house burn down from across the street and not being able to do anything about it. She had rent due in 5 days. Her car payment was set to auto draft. She owed her credit card company $2,400 at the end of the month. And the $340 in her wallet was suddenly all the money she had access to in the entire world. The next 72 hours were chaos. Sarah called every number she could find, sat on hold for hours, and got no real answers. She borrowed $500 from her sister just to buy groceries and gas. Her landlord wasn't interested in hearing about bank failures when the rent was late. The auto payment for her car bounced, triggering a $35 fee and a concerned call from the financing company. Small problems started stacking up, like dominoes falling in slow motion. Now, Sarah was actually one of the lucky ones. Because her balance was under the $250,000 FDIC insurance limit, she eventually got her money back. It took about a week, but that week felt like a month. She later told reporters that the experience completely changed how she thinks about money. She now keeps 3 months of expenses in physical cash hidden in her home. She calls it her Never Again Fund. But not everyone was as fortunate. Marcus Thompson ran a small construction company in Phoenix with a payroll account at Signature Bank. When that bank collapsed 2 days after Silicon Valley Bank, Marcus had $890,000 in his business account. Most of it earmarked for paying his 15 employees at the end of the week. Only $250,000 was insured. The rest was in limbo. Marcus couldn't make payroll. His workers, most of whom lived paycheck to paycheck themselves, suddenly had no income. Some of them had mortgages due. Others had kids waiting for lunch money. Marcus spent that week making personal loans to his own employees from whatever cash he could scrape together just to keep them from losing their apartments. Stories like these exploded across social media in the weeks following the 2023 banking crisis. People who had never thought twice about where they kept their money suddenly started asking uncomfortable questions. And the most common question was the one you're probably thinking right now. How do I make sure this never happens to me? The answer starts with understanding something that most people have completely wrong about how banks actually work. At the heart of modern banking lies something that would sound completely insane if you heard it for the first time. It's called fractional reserve banking, and once you understand it, you'll never look at your bank account the same way again. Here's how it works. When you deposit $100 into your bank account, you probably assume that money sits in a vault somewhere waiting for you to withdraw it. That's not even close to what actually happens. The bank takes your $100 and immediately lends out most of it to other people. They might keep $10 in reserve, maybe less, sometimes nothing at all. Let me repeat that because it's the foundation of everything we're talking about. For every dollar you deposit, the bank might keep 10 cents. The rest gets loaned to businesses, mortgages, car buyers, and credit card holders. Your money isn't sitting in a vault. It's scattered across thousands of different loans that won't be paid back for years or even decades. Imagine if a hotel sold the same room to 10 different guests and just hoped they wouldn't all show up on the same night. That's essentially how modern banking works. Now, in normal times, this system functions fine. Not everyone needs their money at the same time. The bank keeps enough cash on hand to cover normal withdrawals, and everything hums along smoothly. But here's where it gets dangerous. If too many people want their money back at once, the bank simply doesn't have it. The money is out on loan, it's not there. This is what economists call a bank run, and it's essentially a self-fulfilling prophecy. When people hear rumors that a bank might be in trouble, they rush to withdraw their funds. But the bank doesn't have everyone's money, so it starts running out of cash. This confirms the fears and creates more panic. More people withdraw. The bank has even less. Within hours or days, a perfectly healthy bank can be destroyed by nothing more than fear spreading faster than the bank can gather cash. You might be thinking that's what deposit insurance is for. And you'd be partially right. The FDIC was created specifically to prevent bank runs by guaranteeing that depositors would get their money back even if a bank failed. But here's where most people get the details dangerously wrong. FDIC insurance covers $250,000 per depositor, per bank, per ownership category. That sounds like a lot. And for most individuals it is. But there are crucial limitations that could leave you exposed without realizing it. First, the $250,000 limit applies to the total of all your accounts at one bank. Your checking, savings, and CDs all count together. Second, certain types of accounts aren't covered at all, including investment accounts and foreign currency holdings. Third, and this is the big one, getting your insured money back isn't instant. According to FDIC guidelines, the agency aims to make insured deposits available within 2 business days of a bank closure. But that's an aim, not a guarantee. In practice, it often takes longer. During the 2023 banking crisis, some depositors waited a full week before they could access their funds. And if your bank gets acquired by another bank rather than simply liquidated, the transition process can take even longer. Think about what a week without access to your money actually means. Your rent or mortgage payment bounces. Your automatic bill payments fail. Your credit card gets declined at the grocery store. You can't fill your gas tank. Every automatic payment you've set up becomes a potential problem, generating fees and damaging your credit score with each failed transaction. So now you understand the fragile foundation that modern banking is built on. The question becomes, what actually happens when your specific bank fails? What does that timeline look like? And how long will you really be without access to your money? But here's where it gets really fascinating. And it's something that would make most people's stomachs drop if they understood the step-by-step reality of what happens when their bank actually fails. Bank failures almost always happen on Friday evenings. This isn't coincidence. Regulators deliberately time seizures for after the markets close on Friday to give themselves the entire weekend to sort things out before Monday morning. So you might go to bed Friday night thinking everything is normal, and wake up Saturday to discover your bank no longer exists. It's like finding out your house was sold while you were sleeping. The moment regulators seize a bank, your accounts get frozen. Not reduced, not limited. Frozen. You cannot withdraw cash. You cannot transfer money. You cannot use your debit card. Every automatic payment you have scheduled will bounce. Your direct deposit from work might disappear into a black hole. From the bank's perspective, you temporarily don't exist until someone figures out what to do with all the accounts. What happens next depends on whether another bank agrees to acquire your failed bank's deposits. This is actually the best-case scenario. When a healthy bank takes over, they assume responsibility for all insured deposits, and in many cases, you wake up Monday morning with access to your money through the new bank. Your account number might change, but your balance stays intact. But acquisition isn't guaranteed. If no bank wants to take on your failed bank's deposits, the FDIC steps in directly and starts mailing checks. Let me repeat that. Mailing checks. In 2023. While you're sitting at home wondering how you're going to buy groceries, some government agency is literally putting paper in an envelope and dropping it in a mailbox. According to FDIC data, direct payouts can take anywhere from a few days to several weeks, depending on the complexity of the bank's records. Now here's the part that catches most people off guard. Even if everything goes smoothly, even if your bank gets acquired quickly and the transition is seamless, there's still a gap. Financial experts call this the float period, and it's the time between when your old bank stops working and when your new access becomes fully functional. During the Silicon Valley Bank collapse, this float period lasted between 3 and 7 days for most customers. That doesn't sound like much until you think about what 3 to 7 days without money actually looks like. You can't fill your gas tank to get to work. Your kids need lunch money and you can't give it to them. Your electricity bill was due Tuesday and it's now Thursday and your payment still hasn't gone through. One thing that surprises people is what happens to their automatic payments during a bank failure. Most people have rent, utilities, car payments, and subscriptions all set up to draft automatically. When your bank fails, every single one of those transactions fails too. Each failed payment typically generates a fee, both from the company you were trying to pay and potentially from whatever institution eventually takes over your account. People who went through the 2023 crisis reported racking up hundreds of dollars in fees through no fault of their own. And those fees are just the beginning. Late payments get reported to credit bureaus. Your credit score can drop by 50 points or more from a single missed mortgage payment. That damage follows you for years, affecting your ability to get loans, rent apartments, and sometimes even get hired for certain jobs. All because your bank made bad decisions that had nothing to do with you. This is why physical cash isn't paranoid. It's practical. It's the only money you truly control. And now that you understand what can go wrong, you're probably wondering exactly how much you need. Here's the number you've been waiting for. The amount of physical cash you need depends on what kind of crisis you're preparing for. And financial experts generally recommend thinking about this in 3 tiers. It's almost embarrassingly simple once you see it laid out. Tier 1 is your minimum survival amount. This is the absolute baseline that everyone should have regardless of their income or financial situation. The target is 2 weeks of essential expenses in physical cash. Not 2 weeks of your normal spending, but 2 weeks of bare necessities. Food, gas, medication, and maybe 1 or 2 critical bills. For most households, this works out to somewhere between $1,000 and $2,000. Let's say your family spends about $150 per week on groceries. That's $300 for 2 weeks. Add another $100 for gas, maybe $50 for medications, and a buffer of $100 for unexpected necessities. You're looking at roughly $550 minimum, but rounding up to $1,000 gives you breathing room. This isn't about living comfortably. This is about surviving until the banking system sorts itself out, which historically takes about 1 to 2 weeks. Tier 2 is your comfortable buffer. This is 1 to 3 months of expenses, and it's designed to handle longer disruptions or situations where getting your money back takes longer than expected. If your monthly expenses are around $4,000, your Tier 2 target would be $4,000 to $12,000 in physical cash. That sounds like a lot of money to have sitting around, and honestly, it is. But remember what we talked about earlier. If your bank fails and the FDIC takes 3 weeks to mail you a check, having $8,000 in cash means the difference between keeping your life together and watching everything fall apart faster than you can react. Tier 3 is full crisis mode. This is for people who want to be prepared for extended disruptions, whether that's a prolonged banking crisis, a natural disaster that takes down infrastructure, or economic instability that makes electronic payments unreliable. The target here is 3 to 6 months of expenses. For a household spending $5,000 per month, that's $15,000 to $30,000 in physical cash. Now, I know what you're thinking. That's an enormous amount of money to keep outside the banking system. And you're right. Tier 3 isn't for everyone. It's for people who have the resources, who live in areas prone to disasters, or who simply sleep better knowing they have extended independence from financial institutions. Most people should aim for Tier 1 immediately and work toward Tier 2 over time. Here's exactly how to calculate your specific number. Start by adding up your essential monthly expenses: rent or mortgage, utilities, groceries, gas, insurance, medications, and minimum debt payments. Don't include streaming services or gym memberships. You're calculating survival, not comfort. Once you have that monthly number, divide by 4 to get your weekly essential burn rate. Multiply by 2, and that's your Tier 1 target. The beauty of this tiered approach is that you can start small and build over time. You don't need to withdraw $10,000 tomorrow. Start with Tier 1. Get $1,500 in cash this month. The psychological benefit of having even a small cash reserve is enormous. You stop feeling like the banking system has complete control over your financial life, but knowing how much isn't enough. Where you keep that cash and what denominations you use matters just as much as the total amount. And this is where most people make mistakes that could cost them everything in an actual emergency. Now here's where most people get it wrong, and it's a mistake that could render all your careful preparation completely useless when you actually need it. The first mistake is keeping all your cash in $100 bills. It seems logical. Hundreds take up less space, and they're easier to count. But during an actual crisis, $100 bills become a nightmare. Small businesses often can't break them. People get suspicious when you try to pay for groceries with $100. And in a true emergency, making change becomes your problem, not theirs. If a bottle of water costs $3 and all you have is $100, you might end up paying $100 for that water. That's not preparation. That's expensive desperation. Financial preparedness experts recommend what they call the denomination pyramid. The majority of your cash should be in 20s. They're universally accepted, easily broken, and don't raise eyebrows. Below that, keep a solid stack of 10s, 5s, and 1s for smaller transactions. A good ratio for a $2,000 emergency stash would be $1,200 in 20s, $400 in 10s, $300 in 5s, and $100 in 1s. This gives you flexibility for any transaction from a cup of coffee to a week's groceries. The second major mistake is keeping all your cash in one location. You know what I'm talking about, the envelope in the sock drawer or the lockbox in the closet. If a burglar finds it, or a fire destroys it, or you simply can't get to that location during an emergency, your entire safety net disappears in an instant. Smart cash storage means spreading your reserve across multiple locations. Keep some at home in a fireproof safe. Keep some at a trusted family member's house. Keep some in your car, though be careful about temperature and security. The goal is redundancy. If any single location becomes inaccessible, you still have access to part of your reserve. Speaking of home storage, a quality fireproof safe is one of the best investments you can make. We're not talking about a cheap lockbox from the hardware store. A real fireproof safe rated for at least 1 hour of fire protection costs between $150 and $400. Bolting it to the floor makes it nearly impossible for a thief to simply carry it away. One thing most people don't consider is what preparedness experts call the grab bag concept. This is a small amount of cash, usually $200 to $500, kept in a portable container that you can grab in seconds if you need to leave your home quickly. Natural disasters, fires, or other emergencies might not give you time to open a safe and count out bills. Another overlooked factor is cash rotation. Paper currency degrades over time, especially in humid environments. Old bills can become brittle, faded, or damaged. The solution is simple. Use your emergency cash periodically and replace it with fresh bills. Pay for groceries in cash once a month, then replace what you spent from the ATM. This keeps your reserve fresh and functional. This isn't about being paranoid. It's about being practical. You have insurance for your car, your home, and your health. Physical cash is simply insurance for your financial access. And when you actually need it, it's worth more than any policy you could buy. But cash alone isn't the complete answer. There are limitations to physical currency that smart people plan around. But here's where the strategy gets really clever, and it's something that would make Warren Buffett nod in approval rather than raise his eyebrows. Cash has real limitations. It can be stolen. It can burn in a fire despite your fireproof safe. And over time, inflation quietly eats away at its purchasing power like termites in a wooden house. $1,000 today will buy less in 10 years than it does now. This isn't about hoarding cash. It's about building systems. The truly prepared think in terms of what financial planners call the 3 buckets. Bucket 1 is your immediate access fund. That's the physical cash we've been talking about. It's your first line of defense, the money you can access within minutes regardless of what's happening to the banking system or the power grid. Bucket 2 is your short-term accessible funds. This includes accounts at multiple different banks. And here's the key insight that wealthy people figured out long ago. Don't keep all your money at one institution. If your bank fails, strategy. What wealthy people actually do is instructive here. Studies of high net worth individuals show they rarely keep more than the FDIC insurance limit at any single bank. They spread their money across multiple institutions, multiple asset classes, and multiple jurisdictions. They're not paranoid. They're strategic. They understand that concentration creates risk, whether that's concentration in a single stock, a single bank, or a single form of currency. Perhaps the most overlooked asset in crisis preparation is relationships. During actual emergencies, your network becomes as valuable as your bank account. Neighbors help neighbors. Friends loan money. Community members share resources. The compound effect of all these layers creates what financial planners call resilience. Any single point can fail and you'll still be okay. Your bank can collapse, but you have cash. Your cash can be destroyed, but you have accounts at other banks. Each layer backs up the others. So you now understand more about financial crisis preparation than the vast majority of people walking around assuming everything will always be fine. The question is, what do you actually do with this knowledge starting today? Implementing all of this might seem overwhelming at first. Going from zero cash reserves to a fully diversified 3-bucket system doesn't happen overnight. And it doesn't need to. The beauty of these principles is that even taking the first step puts you miles ahead of where most people are right now. Here's what you can do this week. First, calculate your essential monthly expenses. Not your total spending, but what you actually need to survive. Housing, utilities, food, transportation, and medications. Write that number down. Second, divide it by 4 to get your weekly essential burn rate. Third, multiply by 2. That's your Tier 1 target. Most people can get to Tier 1 within a month or two just by withdrawing a few $100s each time they get paid. Go to your bank this week and take out $500 in small bills, 20s, 10s, 5s, and 1s. Put it somewhere safe at home. Congratulations. You've already done more than 90% of Americans who have essentially nothing in physical cash reserves. Once you've hit Tier 1, open a second bank account at a completely different institution. This costs nothing at most banks and credit unions. Set up a small automatic transfer, even just $50 per month. Now you have geographic diversity in your banking relationships without any extra effort. The most common mistake people make is waiting for the perfect time to start. They tell themselves they'll build an emergency fund after they pay off the credit card, or after they get that raise, or after the holidays. But the next banking crisis doesn't care about your timeline. It happens when it happens, and the only people protected are those who started preparing before it arrived. Another mistake is going too far in the other direction. Some people hear about banking risks and immediately want to withdraw everything and stuff it under their mattress. This isn't about extremism. Writing that in U7A, it's about balance. Cash doesn't earn interest. It's vulnerable to theft and fire. The goal is strategic preparation, not paranoid hoarding. And here's something important. Don't tell everyone about your cash reserves. Every person who knows you keep significant cash at home is a potential security risk. Your spouse or partner needs to know, maybe your kids when they're old enough. Beyond that, keep it quiet. Think about this as the cost of financial peace of mind. A fireproof safe costs $200 to $400. Your Tier 1 cash reserve might be $1,500 to $2,000. That's less than most people spend on a vacation. But unlike a vacation, this investment protects you and your family from one of the most disruptive financial events you could experience. The people who survived the 2023 banking crisis with their lives intact weren't financial geniuses. They were simply people who had thought about what could go wrong and taken basic steps to protect themselves. They had cash in a drawer. They had accounts at multiple banks. They didn't panic because they didn't need to. That can be you 6 months from now. And who knows? Maybe when the next crisis hits and your friends are panicking about frozen accounts and bounced payments, you'll be the calm one, the prepared one, the person everyone else wishes they'd listened to while they wonder how you make it look so easy.